Good morning, everyone. I am Professor Neeru Basist from the Department of Commerce, and today in this lecture we will learn about basic concepts of income tax, something that we start with before we start to learn about details of income tax. What is income tax? Income tax is, by the name itself, very clear. Tax paid by a person on his income earned in the previous year. However, the income is taxable in the assessment year. When we talk of this definition, a lot of concepts need some clarity, and the concepts include tax, person, assessee, previous year, assessment year, gross total income. When we talk of income, we need to be very, very clear of the income in two senses of the term. One, gross total income, and the second is total income. So let's talk of each of these concepts in sequence so that when we proceed with the subject in detail, we are very, very clear of what we mean by these terms. Now, what is tax? We all know tax is a payment in the form of outgo of cash. So when we talk of tax, we talk of payment made by a person to the government on income earned by him. So it's a clear definition, clear understanding of the term, that it's a payment that a person makes on the income that he earns in a year. The concept of year we'll talk of a little later, and it goes to the government. Now we said this is the tax which is, or it's an outgo of cash, which is paid by a person. So we got to be knowing the meaning of the term person. Who is a person? In the language of income tax, person means anybody who earns income. So we do not talk of person as a natural individual entity, but it is any entity who actually earns income. And the entity need not necessarily be an individual. So who all can earn income? Income can be earned by an individual, you, me, any natural person, any natural individual will be called a person. It could be a Hindu undivided family. So when we have an undivided family, let us say a joint family of X, his wife, his children, you could have a minor child, you could have a major child, they all together constitute a Hindu undivided family, and the business in the name of the family when earns income, that income is also liable to be taxed, not in the name of X or his wife or his children, but in the name of the family. So who becomes a person? The person becomes the family. Then we have company. We all make P&L account of various companies, and the profit of the P&L account is taxable not in the hands of its board of directors or any other governing entities, but that income is taxable in the hands of the company itself. So who is earning income? The company is earning income. So who is a person? That company becomes a person. Then we have a firm, a partnership firm which carries on business, let's say X, Y and company. So we have a firm of two partners here, X and Y. It could even be more than that. It could be 3, it could be 4. So when we have these two partners who are running a business in the name of X, Y and company, the profit of that firm will be taxable as income of the firm as per the law which applies to assessment of income to partnership firm. So assessment of income of various persons depending on the entities is different. Then we have association of persons or body of individuals. Then we have local authority. For instance, in our country, Municipal Corporation of Delhi is a local authority. So income earned by MC/D would be taxable in the hands of MC/D, the person being the authority, MC/D. And every artificial juridical person, the person who is treated as a person in the eyes of the law. So anybody who is not covered under the earlier categories of individual, HUF, company, firm and local authority, nonetheless is liable to be taxed, would be treated as artificial juridical person. A Delhi University, for example, any income which is earned by the Delhi University would be taxable as income of university being an artificial juridical person. So we are clear of the term person. Now we come to define the meaning of the term assessee. While an individual or HUF or an entity who earns income is a person who is an assessee. Assessee is a person who is liable to pay tax under the Income Tax Act. So I may be a person, but I may not be liable to be taxed. When would that be? Let's say my income is below the taxable limit. The taxable limit, let's say, is 2,50,000 and my income is 2 lakhs. So I am earning an income. So am I a person? Yes. Am I paying tax? No. So would I be called an assessee? No. So when is a person liable to be called an assessee? When he has to pay tax. So we have certain categories that we need to understand when we talk of the term assessee. Assessee includes what? A person by whom tax or any other sum of money, any sum of money, it could be interest on tax, it could be penalty of tax. So it need not necessarily be the payment of tax, but anything that is related to tax also makes him liable to be called an assessee. Then we have in respect of whom proceedings under the Act have been taken, whether or not he is liable to pay tax, interest or penalty. Any proceeding, any communication that we have with the Income Tax Department, maybe it is in the form of a refund that you want to claim from the department, even then you would be called an assessee. So the basic point to be understood is, if you have any contact with the Income Tax Department, if you have had any kind of proceeding with the Income Tax Department in terms of anything, more tax having been paid, less tax having been paid, an order having been received, or some interest or penalty that you have to pay, you will be called an assessee. Then we have deemed to be an assessee. You are not an assessee, but you are treated as an assessee. So if you are representing somebody else, you are deemed to be an assessee. And then assessee in default. If we commit a default, if we commit a mistake, even then we would be called an assessee. We are not liable to be taxed, but we would still be treated as assessee because we have committed a default. The sub-points that we can cover under assessee in default is a person who does not deduct TDS. Let's say I am working as an employee for an organization. My employer has to deduct tax on my income and then pay me the balance money. If he does not deduct tax, he is faulting in his liability. He is faulting in his responsibility to deduct tax, and therefore he will be called assessee in default. 2. Who deducts but does not deposit with the government. Now naturally, if my employer deducts tax on my behalf, he has to deposit it with the government. So if he deducts it, the first condition satisfied. But he does not deposit that tax with the government. Even then he would be called an assessee in default. And a person who does not pay advance tax. On self-earned income, since there is no deductor of tax, on self-earned income, for instance, I have income from business, I have to pay advance tax, which is paid while we are earning income in 4 installments spread over a period of every 3 months during the previous year. If we do not do that, again, we would be called as assessee in default. So, having been clear of the concepts of person and assessee, a question comes to our mind: is every person an assessee? No. Only those who pay tax are assessees, right? So when my income comes in the tax net and I'm liable to pay tax on it or have any kind of proceeding with the income tax department, only then would I be called an assessee. If I'm just a person, I'm just earning income, I am not an assessee. However, I am a person. Is every assessee a person? Yes, because assessee naturally is the one who's paying tax, and when you're paying tax, you're definitely earning income. So, every person need not be an assessee, but every assessee is a person. Then we come to define the concept of previous year and assessment year. So, one part of it we are clear. What do we mean by tax? We are also clear of the difference between person and assessee. Now we got to know what is previous year and what is assessment year. Previous year is the year in which income is earned. When we talk of income tax, we always talk of the year as being the financial year. Financial year means starting from April to next March. So, the year in which income is earned. Let's say the current running year is 23-24, April 23 to March 24. So, my previous year would be April 23 to March 24. And income earned during this period of April 23 to March 24 is the income that is liable to be calculated for the purpose of payment of tax. It's the financial year. As I said, it is April to March. Financial year means year starting from April and ending on March. It's the financial year starting from 1st April to 31st March of the next year. For instance, 22-23. We can talk of any year. The running year is 23-24. We are talking of previous year means 22 April to 23 March. Immediately precedes the assessment year. Year succeeding the previous year is assessment year. So, the year preceding the assessment year is previous year. Which means if we talk of the previous year as 22-23, the assessment year would be 23-24. Previous year is uniform for all assessees for all sources of income. Let's say I'm earning income from two different sources. One where I'm maintaining my books from April to March, and other where I'm maintaining my books from Jan to December. The books that I'm maintaining from January to December have to be converted into April to March, because I cannot have two different previous years for two different sources of income. So it is uniform for all assessees, for all sources of income, and that is always the financial year, April to March. As I said, books of accounts can be maintained on some other basis also. I can always have my books of account on the basis of calendar year. But that calendar year has to be converted into financial year when I ultimately compute my income for the purpose of payment of tax. But if it's a newly set up business, let's say in the year 22-23, on 1st of April, I do not have any source of income. I start my business on 1st August 22. So would in that first year, previous year, be starting from 1st April? No, because I don't have any income as on that date. So when would my previous year start? From 1st August 22, however, it will end on 31st March 23. So in case of a newly set up business or profession, previous year can be a period of less than 12 months. As I said, if you start your business on 1st of August, your previous year will be August to March. Subsequent previous years, of course, assuming that the business will continue in future also, while the first previous year is August to March, next all subsequent previous years would be April to March, right? For instance, X starts a business on 15th June 22. We are starting a business in the middle of the year. So 1st April 22, no source of income exists. So what will be his previous year? His previous year will be 15th June, right on the date when the source of income comes into existence, but will end on 31st March 23. Subsequent previous years would be 23, 24, 24, 25, 25, 26, so on and so forth, all financial years. Now what is assessment year? Assessment year is the year in which income is taxed. So while the income is earned in 22-23, it will be taxed in 23-24, which means what? For income that we have earned in 22-23, we are liable to file the income tax return up to July 23. And July 23 falls in 23-24. And since my final tax proceedings will be conducted by the department in the next year, maybe I have to pay more tax, maybe I have to pay some interest, maybe my tax was wrongly calculated, maybe I'm due for a refund, anything, all that would be done after I file my income tax return, which falls in the next year, which means my final assessment of all that I have done while filing ITR is correct, shall be done in the next year. It will be assessed in the next year, and therefore we say it is the year in which income is taxed, and it always succeeds the previous year. So for the previous year 22-23, the assessment year will be 23-24. While the previous year can be a period of less than 12 months, given that the source of income newly comes into existence, assessment year can never be a period of less than 12 months. It is always a period of 12 months. For previous year 22-23, as I said, assessment year will be 23-24, governed by the rules which are announced in the budget, finally incorporated in the act which is called Finance Act 23. So for assessment year 23, when the budget is announced, it is converted into Finance Act 23, and that applies to the income that has been earned in 22-23. So we can just have a glance at the difference between the concepts of previous year and assessment year to recapitulate. For 22-23 financial year, which is the previous year, assessment year is 23-24. That also is a financial year. As good as previous year is a financial year, April to March, so is an assessment year, financial year, April to March. The year in which we earn income is previous year. The year in which income is taxed is assessment year. Previous year, as I said, can be a period of less than 12 months also, but assessment year is always a period of 12 months. Naturally, while previous year precedes the assessment year succeeds the previous year. However, there are certain cases when, we call them exceptions, when previous year is the same as assessment year. We talked of the fact that assessment year always follows the previous year. But there are certain situations when previous year is the same as assessment year. That is, the previous year itself becomes the assessment year. Income would be assessed in the same year, let's say 22-23. We do not wait for income to be assessed in the next year. When does that happen? There are specific situations when previous year and assessment year are the same. One, income of non-resident from shipping company, non-resident. There are conditions that we'll talk of later. There are conditions that make a person non-resident in India. So if you're a non-resident and above that you're having income from shipping business, you may be transporting goods or people to other country through sea, then before you leave the port of the country, you have to clear your tax dues in the same year, which means previous year and assessment year become the same. Similar situations are income of persons leaving India permanently or for a long period of time. If you are going to leave the country for the good, naturally you are not going to come back, and therefore you have to clear all your dues, and though assessment year and the previous year become the same. Income of bodies formed for a short duration. You have set up a venture for a short period of time, and after that period of time the business comes to an end, the venture comes to an end. So since there is no continuity of business, previous year and assessment year once again become the same. Person trying to alienate his assets with a view to avoid payment of tax. If you want to transfer your assets to somebody else to avoid payment of tax, you cannot do that, because once again you have to clear your tax dues while your assessment year and previous year become the same, and discontinued business. Just as you form a body for a short duration of time, if it's a business which is discontinued, you do not want to have a next year in which you are carrying on your business, your assessment year and previous year become the same. So that is what we need to be knowing about the second set of concepts in the basic concepts, previous year and assessment year. And the final thing that we got to know is income, which includes gross total income and total income. Income of previous year is chargeable to tax in the following assessment year at the rates applicable for the assessment year. I've already talked about that. The rates are always announced under the they're always cleared in the Finance Act and always apply to the assessment year. Income is earned for the previous year, but tax rates always apply for the assessment year. Tax rates are fixed by the Annual Finance Act. I've already told that. For example, tax rates for assessment year 23-24 are fixed by the Finance Act 23. Income can have two connotations. One is gross total income and other is total income. Tax is always paid on total income, not on gross total income. What is gross total income? Gross naturally means we need to club certain sets of incomes and that makes it gross. So what all things are we adding so that the income becomes gross total income? Under the Income Tax Act, we have 5 specific heads of income. 1, income from salaries. There are ways to compute income under each head. While we compute income separately for each head, then we add them all together. We have income called as gross total income. So we have income from salaries, then we have income from house property, we have profits and gains from business and profession, we have capital gains and a residual source of income. Anything which is not covered under the first 4 heads of income nonetheless is taxable would be incorporated under the 5th head of income, that is income from other sources. We also call it as residual head of income. Any expenditure incurred in earning such income shall be deducted while computing the said income under a particular head. For instance, profits and gains. I make a P&L account, I credit all my incomes, I debit all my expenses, and the difference would be my income. Similarly, for many other things, if you are incurring certain expenses, be it capital gain, be it a house rent allowance, be it some other allowance in salary, we give allowance for the expenses. And after computing that is the taxable portion that we keep on adding that makes up the income under a particular head. Now what is total income? Total income is gross total income less deductions. Deductions are given specifically under section 80C to 80U. We'll discuss sometime else in some other chapter about the deductions under 80C to 80U. So when on gross total income we give deductions under 80C to 80U, we arrive at a figure called net income, also called taxable income, right? Let's say we have income from salaries worth 15 lakhs per income and income from house property worth 4 lakhs 80,000. If X invests 1 lakh 50,000 in PPF to claim deduction under 80C, his income would be what? Now, we have 2 heads of incomes over here. One is salaries, and salaries is 15 lakhs. House property, computed. Computed means after claiming all expenses on house property, we have taxable income under the head house property. So that is 4 lakhs 80,000. So what is our gross total income? 19 lakhs 80,000. Now we said total income is gross total income minus deductions. So deductions under 80C we have clearly written here are 1 lakh 50,000. So on this 1980, which is the gross total income, we are giving a deduction under 80C 1 lakh 50,000. So our net income is 18 lakhs 30,000. Now what is income? When we talk of the term income, it naturally comes to our mind that it is something that results in an inflow of cash. But we have certain principles that we have to keep in mind when we talk of the concept of income. And these principles are that there should be a regular and definite source. I have already told you there are 5 heads of income. You have to have a source under which you designate the cash. If I'm earning 5 lakhs, it has to be either of the 5 sources, be it salary, house property, business, capital gain or other sources. Though, however, the source need not be in existence, which means if I have ever had an income from house property before, and after that I sold off the house while there was an unrealized rent on that, for which I had filed a case in the court of law. In a subsequent year, I realize that money, my tenant pays me that money, but my relationship with the tenant of the owner and tenant no more exists because my tenancy has been extinguished. So while I have income which is received under the head house property, but I do not have a tenant anymore, would that be still taxable under the head house property? Yes. So the rule is it must have a source. While the source is not in existence in the same assessment year, that's okay. Income can be in different form. It can be in cash, it can be in kind. If it is in kind, we have to convert the kind part into the monetary equivalent as per the rules framed for conversion. Receipt versus accrual. Income can be on receipt basis when you actually receive it. It can be on accrual basis where you do not receive it but it has only accrued to you. For instance, you have a fixed deposit. Let's say you have a fixed deposit of 3 years. Every year interest accrues to you, but you receive the interest after the maturity of the deposit, let's say 3 years. So would my interest be taxable each year even if I am not receiving it? Yes, it will be taxable on accrual basis. Disputed title. Even if there is a property which is subject to dispute, let's say there's a house where there's a dispute as to who is the owner, X or Y, who finally pays tax on income derived from that house? The person who actually receives the income. So the title, even if disputed, has no relevance so far as tax is paid. The person who actually receives cash in his account is the one who has to pay tax to the government. Reimbursement of expenses is not income. Let's say my employer reimburses to me my medical expenses or my traveling expenses. So if I incur some expenses on traveling, say 10,000 this year, next year I get a reimbursement of that 10,000. So would that 10,000 be taxable again next year? No, because this has already been taxed as a part of my income the year in which I earned. So reimbursement will not be considered as taxable. Diversion versus application. It's an important point. Application means use. Anything that I'm using my income for, let's say I'm buying my food or I'm paying my bills or I'm paying for the education of my children, would that amount be subsequently deducted from my income and only balance would be taxable? No, because my entitlement, my right to receive income is on the whole amount. So that whole amount will actually be taxable. Application is not taken into consideration for the purpose of computing the income. However, diversion means I lose the right over that income. Let's say X and Y take up a project jointly and they earn 10,000 on that, over which each X and Y have equal right, 50-50. If the money goes in the account of X, the entire 10,000, X will pay tax only on 5,000. Y will pay tax on 5,000. Why? Because the money has been credited in the account of X, but X does not have right on this entire amount. He has right only on the part of the share, which is 50%. That is called diversion. So diversion is not taxable. Temporary and permanent, both incomes are taxable. Whether you receive it just once, say you buy a lottery ticket, you earn some income on that, even that is taxable. However, it is temporary. Permanent, you have a regular source of income, you have let out your house on rent, or you are working and you are earning salary, or you have a business, you have a regular source of income. Either way, your incomes are taxable. Lump sum, any areas. For instance, you receive bonus of earlier years or you receive DA areas for earlier years. Would that be taxable? Yes, always in the year of receipt. So whenever you receive arrears of anything which relate to earlier years but you receive them today, arrears are taxable on the basis of receipt. Tax-free income. What does tax-free income mean? Tax-free does not mean on which we do not pay tax. Tax-free means on which tax has already been deducted by the deductor. Let's say you are getting income from salary 1 lakh per month. What amount comes in hand? Let's say 90,000. 10,000 is the tax which has been deducted by your employer. That 90,000 which I get from my employer is termed as tax-free income. But when I'm calculating my income for the purpose of payment of tax, I will calculate it as 1 lakh. Therefore, the tax which has been deducted will be added back to my income. That is, it is grossed up. So grossed means the net amount that I receive plus the tax which has been deducted on it. Net plus TDS. Revenue versus capital receipts. As a rule, capital receipts are exempt from tax. Let's say I have a life insurance policy, and when it matures after whatever number of years for which I have taken the policy, that will be exempt from tax. But are all capital receipts exempt from tax? No. We have a very specific section 45 which lays down the incomes which are taxable as capital receipts. So the basic rule is capital receipts are exempt except if they are expressly specified to be taxable. I sell my gold, I sell my jewelry, I sell shares, I sell debentures, I sell bonds, land, building, anything. When I sell all this, my income is capital receipt, but it is taxable, right? Why? Because the section 45 clearly talks of the rules of taxing it. Contrary, revenue receipts are taxable. Revenue means something that I am earning. My salary, let us say. I am getting it every month. That's my revenue receipt. So that is taxable. But revenue receipt will be exempt if expressly specified to be taxable. I am getting house rent allowance. Maybe I am staying in a rented house. I am paying rent for that. So a part of my house rent allowance will be exempt from tax as per the rules of the law. So capital receipts are exempt unless specified to be taxable. Revenue receipts are taxable unless specified to be exempt. The basic rule. What is the difference between capital and revenue? Receipts on account of circulating capital will be revenue, and receipts on account of fixed capital would be capital. This is self-explanatory. Receipt in the hands of recipient is important. Payer's motive is not important. Importance is the person who is receiving the income. Let's say a furniture seller. He sells his furniture and I pay him for the furniture. For him, since it's a part of his regular business, that receipt would be regular revenue receipt. But if I sell my furniture, I'm not dealing in furniture, income that I earn on sale of furniture would be capital receipt, right? So what actually matters is the person who is receiving the income. Lump sum or periodic payment. It does not matter whether the receipt is lump sum or you get it in terms of installments. So I've tried to make clear the concepts that we must be very, very clear of before we learn the subject of income tax. Thank you so much.